Now we're going to go over customer accounts. Okay, this section should be hopefully pretty straightforward for most of you. You've got an individual account, which is just an account with one person. Super straightforward. A joint account is with two or more adults. Okay, there's two types of joint accounts you need to know. There's joint with rights of survivorship, which is what you would have with a spouse. If I die and I have a joint with rights of survivorship account, then my spouse will just take over my account, that she will inherit the entire account. The other type of account that you can open is what's called tenants in common. Tenants in common, if I die, then the portion that is my account, or so let's say it's 50-50 between me and my brother, well, my 50% will go to my beneficiary, to my estate, as opposed to going to the other account holder. Okay. So normally, if you're opening up an account with a spouse, well, then you would do joint with rights of survivorship because your spouse is probably your beneficiary. So if you die, you just want her to get everything. If I'm instead opening up an account with a friend or with a colleague or with a sibling or something, well, I don't want my share of the account to go to that friend or colleague or sibling. No, I want it to go to my kids, my estate. Okay. So I would open up tenants in common. So definitely know the difference between the two. You'll probably get a test question on joint accounts. And here, I've already gone over it. So with tenants in common, you have a fractional interest in the account. Whatever amount you put in, that's the amount that is your account. With joint with rights of survivorship, you're both considered equal owners. Okay. So if I open up an account with my spouse and I put 100 grand in, she puts in nothing. Well, guess what? It doesn't matter who put in what. It's equally our account. She could withdraw the whole 100 if she wanted. I can't say no. Okay. So you have to have some trust when it comes to a joint with rights of survivorship. All right. And again, if I died, that 100K would just go to her. Whereas tenants in common, if I put in 100, well, I could do it with a brother. My brother could put in 100, then we're 50% owners. All right. If I die, my 100K will go to my estate. All right. And my brother will keep his 100K. So that is how that works. If you have an account, generally an individual account, okay, you can add a transfer on death, which means that you specify who your beneficiary is. Okay. So if I have an individual account and I were to pass away and I did not have a TOD on file, then my account balance would go to my estate. And when it goes to the estate, then it goes to the probate court, and the probate court decides how to distribute the assets. Okay. So it probably would fall along the same lines of what I want, but not necessarily. So let me give you an example. I have two kids. Let's say one of my kids I don't really like. Not true, but let's just say I have one kid that I don't like, one kid that I do like. So if I die and I do not have a TOD on file, my account would go to the estate, and then the court would say, okay, Tim has two kids, 50% goes to this kid, 50% goes to that kid. Well, remember, I have one kid that I don't like, and I don't want that kid to get any money. So if I wanted to avoid that, I would add a transfer on death to my individual account. And then if I died, my TOD would say all of Tim's money goes to kid number one. And sorry, kid number two. And so then instead of going to the probate court and the probate court splitting it up, instead they're going to go ahead and just give all the money to my one kid that I like. Okay. So that's a transfer on death. It's basically just a beneficiary agreement. Okay. But we call a beneficiary agreement, we call it that for an IRA. For non-taxable accounts or excuse me, I shouldn't say non-taxable, non-qualified accounts, we call it a TOD, transfer on death. And you can even hear it called a payable on death, POD. Okay. So do be familiar with that. You want to be familiar with that just regardless. That's important for you to discuss that with your clients, that they have a TOD on file. Okay. And the other thing about probate, when it goes to the estate, well, the probate court charges you a fee. So you can avoid probate fees if you designate a TOD. Okay. And then a POA is a power of attorney. So that means that I'm giving the right to somebody else to go ahead and make, withdrawals on my account and affect transactions. Okay. So on any estate plan, you would generally recommend that your clients, especially say a married couple, that each one of them has power of attorney over the other, assuming they trust each other. And that way, if one of the parties gets incapacitated, well, then the other party has the right to go ahead and access their other accounts. Okay. So, if you've got a husband and wife and the husband doesn't give his wife POA, well, if he ends up in the hospital and needs to take a withdrawal from his individual account, the wife calls me and I'm gonna have to tell her, sorry, I can't take your instructions. I can only take instructions from him. Okay. Unless we have a POA on file. And a POA must be in writing. We do not accept verbal power of attorneys. So that is key. Make sure you know that. Okay.
Question.
Yep.
If that's in a will, is that in writing?
Um,
How's that work?
yeah, so your will only comes into effect when you die.
Mm-hmm.
So your will would elect an estate executor, and so then the executor would be able to go ahead and control it. But if you die, or excuse me, a power of attorney can only be used when you're alive. Okay. So if I die, it doesn't matter who my power of attorney is.
Right.
It ceases to be in effect. Okay. So then it
But
just
if
goes
you
to
have
my
a
will.
general power of attorney,
Mhm.
um, it doesn't matter. I mean, you're obviously using it when you're alive.
Yeah, you're using it when you're alive. And so
Or
the
should
power,
they sign forms with us besides the power of attorney, the general power of attorney?
yeah. So, I mean, what we would recommend is that your client has a POA for while they're alive. And then
Mm-hmm.
they also have a will designated, and in their will, they designate who the executor is going to be. And it's probably the same person as the POA.
Mm-hmm.
Because if you don't designate who the executor is, well, then the probate court's going to decide that for you. Okay.
Okay.
So, yeah, no, absolutely. Good question. Okay. So the business accounts, we've got sole proprietor, partnership, and corporation. So what you need to know, a sole proprietor is the easiest account to form. Okay, it's the easiest business to set up. I can literally take a pitcher of lemonade outside on the street and start selling lemonade. And guess what? I'm a sole proprietor. That's how hard it is. It literally takes no documents to open up. Okay, I just have to go sell something. A partnership is going to be between me and another person. Okay. So me and my friend who are opening up the pizza shop, we form a partnership agreement. Okay. And then a corporate account would be I form a corporation. Our pizza shop is doing really well, so we decide to incorporate it and we form Papa John's. Okay. So the partnership has a partnership agreement, and of course it needs to be in writing. A corporation has a corporate charter, and that needs to be in writing. Any changes to either of those documents need to be done in writing and need to be agreed upon by all parties. Okay. The other type of account would be a trust account. So a trust account, there's two types, revocable and irrevocable. Okay. And I'll go over those two types, but real quickly, on a trust, there's three terms that you need to know. The grantor is the person who creates the trust. The trustee is the person that manages the trust. And then the beneficiary is who the trust is ultimately for. Okay. So I'm going to give you some examples here. Okay. So we say a living trust and then there are three different, don't take this as there being three different types of trusts. Really, there's two types of trusts. Okay. There's a revocable and an irrevocable trust. An irrevocable trust cannot be changed. Once you create it and put money into it, you cannot change it. The only people that do irrevocable trusts are the super wealthy. And by super wealthy, I mean they have to have an estate worth more than $10 million. Okay. So for the purpose of this exam, you really should not be tested on an irrevocable trust. All right. The only thing you would be tested on is that it cannot be changed. It avoids estate taxes, or it's a way to avoid estate taxes. And then the other thing that I would mention on an irrevocable trust, the grantor, the person who created the trust, and the trustee cannot be the same person. Okay. The thing with an irrevocable trust is I'm giving some money and I'm relinquishing that money. Okay. I can no longer control it. So if I have an irrevocable trust, I can be the grantor, but I can't also be the trustee. I can't control how the trust operates. All right. I am not allowed to. So an irrevocable trust, that's what it is. Again, estate tax purposes, and shouldn't really be tested. A revocable trust is the type of trust that you'll probably work with your clients. Okay. So a revocable trust basically just is like a will. Okay. It just says, this is how I want my account to be structured when I die. Okay. So with a revocable trust, I can serve as the grantor and I can serve as the trustee. Okay. And then it would be for the benefit of my beneficiaries. Okay. So the way it works with a revocable trust is, it just allows you more control over your assets. So like I said, if I were to die, I've got 2 kids. So, the estate or the probate court would say, okay, well, we're going to divide it 50-50 to Tim's 2 kids. Okay. But my kids are under 18, so they would put their mom in charge of it. All right. Well, if I want more control, what I could do is I could create a revocable trust. I'd be the grantor. I'd be the trustee while I'm living. Okay. It's for the benefit of my 2 kids. If I die, then I'm going to name another trustee to manage it. And so let's say I don't want mom to manage it. Maybe she's not very good with money. Instead, I want to have my sister manage the trust on behalf of my kids. So with the revocable trust, I could do that. I could go ahead and say, instead of their mom being the trustee, I want my sister to be the trustee. And so if I die, then my sister is going to go ahead and manage the trust on behalf of my kids. Whereas if I died without a trust in place, well, it would just go to the probate court and the probate court would do it very down the line. It would say, okay, well, there's 2 kids here. They're each going to get 50-50, but they're under 18. So mom is going to go ahead and control it. Okay. So revocable trust just gives you more control, more say over how the funds are going to be managed at death. All right. And then with a revocable trust, there's 2 types of revocable trusts. There's what's called a living trust, which is point 1. And then point 2, or well, we don't have a point 2. The second type is called a testamentary trust. Okay. So a living trust just means that it is created while I'm alive, whereas a testamentary trust is created in my will. Okay. So what I could do in my scenario, I want my sister to be the trustee and I want it for my 2 kids. Well, in my will, I could say, when I die, create a trust where my sister's the trustee and my kids are the beneficiaries. So if I die, then we're going to go to the probate court. The probate court's going to read my will and they're going to say, oh, Tim wanted a trust established. So we're going to establish a trust and we're going to go ahead and split the assets the way that he's outlined it. The problem with a revocable trust, with a testamentary trust, is that it's created at death. So it still has to go to the probate court. So I'm still going to be charged a probate fee on my assets. All right. So, with either a living trust or a testamentary trust, I still get to control how my assets will be distributed. But with the testamentary trust, it still goes to the probate court. So I'm still going to be charged a fee by the probate court. And that fee is usually like 3 to 4% of your assets. So it can be pretty significant. Okay. If I want to avoid probate, then I would do a living trust where I would create the trust now while I'm alive. I would go ahead and title my beneficiary to be my trust. And so then when I die, it goes into the living trust, which was already created. Okay. The downside to doing a living trust is, well, I've got to set up the trust right now, which guess what? That's probably going to cost me about $1,000, or depending on the lawyer I go to, could be even more. Okay. So that would be a living trust. Okay. The other types of accounts, we have custodial accounts. Okay. So these are UGMAs or UPMAs. And really the only difference between an UGMA and UTMA is that an UTMA allows for additional securities to be held. So UGMAs are usually like stocks and bonds. UTMAs are stocks, bonds, and property. Okay. And a custodial account is just if I want to set up an account for my kid, a minor, somebody who's under 18. Okay. Well, they can't have their own brokerage account. So what I would do if I want to go ahead, let's say I want to donate a share of Disney every year to my son for his birthday. Well, I'll set up a custodial account, an UGMA or an UTMA, and then I'll buy a share of Disney every year for him. I'm the custodian. The account is in my son's name and it is in his social. It's in the minor's social, but I'm the one who's in control of the account. Okay. I place all the trades. I can do the withdrawals, whatever I want. Once my son reaches the age of majority, which would be either 18 or 21, depending on the state, you don't need to know, you just need to know age of majority. You don't need to know it's 18 or 21. Okay. But once he reaches 18 or 21, it's his account. So I don't care whether I want to give it to him or not. He's 18, so he can go ahead and just contact the broker and say, hey, this is my account, transfer it into my name. All right. So that's the downside of a custodial account. All right. So if I were worried that my son, when he turns 18, is going to go ahead and cash out his UGMA and buy a bunch of Pokemon cards, well, then I would probably create a trust for him. And I would instead buy the shares of Disney in the trust. And when he turns 18, well, guess what? I'll tell him, yeah, you've got this nice trust account that you can withdraw from. But guess what? You can only withdraw from it for education expenses or to start a business. You can't withdraw from it to buy Pokemon cards. Okay. So that would be a custodial account. And then the other two types of accounts, Coverdales and 529s. So we've already gone over 529s. Those are the education accounts that are run on a state level. Make sure you remember that. A Coverdale is less tested and they're not used very much because the amount you can contribute is $2,000 per year. And there's phase outs for wealthy people. If you're earning more than like $190K, and you don't need to know that figure, you can't even contribute to a Coverdale. And if you know the cost of tuition these days, $2,000 is not going to get you very far. So Coverdales are not really used very often. They used to be used primarily for like K through 12 expenses. So if you wanted to send your kid to a fancy boarding school or something, well, you could use it for that. But like I said, with 529s, because of the Secure Act, you can now use those as well for K through 12 expenses. So there's almost no purpose of setting up a Coverdale. But Coverdales are another type of education account, very small limits, $2,000 per year. And technically there's more investment options on a Coverdale. On a 529, your state chooses what you can invest in. Okay. So like I'm from Colorado. So my 529 in Colorado, they say, hey, you can choose Vanguard, you can choose First Bank, or you can choose Mass Mutual. And those are the three providers that you can choose to invest your money with. If it's a Coverdale, I can just open that with Charles Schwab and I could go and buy Facebook stock with them, whatever I wanted. Okay. So you have the investment say on a Coverdale, whereas with a 529, the state decides. I mean, you still get to decide like which Vanguard fund you invest the 529 in, but the state decides, hey, you've got to invest with Vanguard or you've got to invest with Fidelity, whatever it may be. Okay.